Welcome back to another edition of Sunday School with your boy Buck Bandit P here on the Financial Corner, man. You already know, man, what we do here, man. But if you don't, we break down investing for average, everyday people so we can go out here and get this money. You already know what it is. But it ain't no excuses, no shortcuts, just progress. That's all we on over here. You already know what it is, man. So before we get started, man, if you want your free stock, your free share of Robinhood, just click the link down below, click the link in the bio. You already know, man, what it is, man. We here to get this money so you can get off the sideline and actually start printing this bread. And also, if you want to open up your high yield savings account with Allah, click the link right there, man. You already know. Get your free $100 when you open up a high yield savings account with Allah, man. A bunch of other stuff down there, man. Just make sure you go down there and check it out. But once again, appreciate y'all for being here, man. So let's get right into why we here today, man. You already know. Listen, we gotta get into interest rates. We got to get into the Federal Reserve and how they control the whole shebang, how they control everything. They controlling all the money. So if you don't understand interest rates and you don't understand what the Federal Reserve does, honestly, trying to get a bag and trying to get money is pointless, because you're not even going to know what to do with it. You're just going to you're going to be like the hamster on the wheel. You're just going to be going round and round, what they say, the rat race. Like, if you don't figure out the rules to the rat race, most likely you're going to end up in that joint forever and you ain't never going to figure it out. So let's start here with how interest rates drive market cycles. All right. So most investors think that the price move. We already went over. Most people think that the price of a stock move based on earnings and based on news and politics and hype and all that. Listen, those things do matter. Not saying they don't matter and they don't play a part, but that's not the major thing. The major thing that controls the market is money. That's the major thing that controls the market cycles, is money. So we have to understand everything we need to know about money. And if we don't understand interest rates, 9 times out of 10, you're going to always be behind the 8 ball, because you might think that you're saving money, but if you ain't keeping up with inflation and you don't know what the rates is and you don't know when to buy and when to borrow, like, all of that plays a major part in building your wealth. So let's get right into it. The biggest driver, like I said, is money, and most specifically about money, how expensive or cheap it is to borrow money. Like, you'll hear things like people say, oh yeah, money is cheap or money is expensive. And if you don't understand interest rates and what the Federal Reserve that sounds like drip. You like, what? Money is cheap, money is expensive. Money is money. $100 is $100. That's not the case, my man. That's not how it goes, baby girl. Like, that is not how it goes. And I wish I knew this longer, then I would have learned how to get myself in better position to actually keep more of my money. So all it is how cheap or expensive money is to borrow. That's all that controls the market. So let's get into it. The Federal Reserve, their main thing is when they lower the interest rates, money is cheap. And when money is cheap, everything changes. That's when businesses borrow more money. That's when people buy more houses. That's when people leasing more cars. That's when cheap money pushes into assets like stocks, real estate, crypto, and venture investments. Okay, so this is why bull markets usually begin when interest rates are low or falling, because when interest rates are low, when they fall, and people gonna be rushing to refinance their house. I'm getting this loan for this business, I'm getting this loan for that, because the interest rates are low. So money is cheap to borrow. I know if I can make 10% return on this money and I'm only paying 4% to get this money, that extra 6% is what I'm making. You understand? So liquidity, when liquidity flood the system assets and prices rise. And everybody feel like they're a genius. We already went over this time is different, everything popping, everything good money, right? But that also creates bubbles. We just went over the AI boom and how that's over, because when money is cheap, people borrow money, putting them in their businesses, trying to hurry up, get a return, and it's just going like this. And eventually it's going to create a bubble and things are going to become overvalued. And that's why money don't stay cheap for too long. Like, that's why the Federal Reserve will come in and they'll raise rates. So that is the whole cycle of money, why money being cheap and what happens when money is cheap. And then you start seeing things like, this is a good sign when you know money is cheap. You start seeing speculative stocks, like speculation stock companies just coming up out of nowhere, valued at millions of dollars, and they ain't produced $1. Like, they valued at hundreds of millions and didn't produce nothing. Like, that's when you can start to see, oh, it's starting to be a bubble. A bubble is forming. And that's why everybody was like, oh yeah, this AI thing is a bubble. And it turns out they was right. So that's when you see meme stocks. That's when you see a bunch of people IPOs, like they taking their companies public because money is cheap. Like, I'm just going to take my company public, and I'm going to get this money out of the market because money is cheap. Everybody's flooding the market. The market is green. This is the bull market I'm talking about. So when that happens, that's when the Fed gonna come in and they gonna be like, hold up, we gotta raise these rates. All right. And this is when markets enter the late stage of the bull cycle. All right. And then what usually happens is inflation comes in. And then once inflation starts getting high, then what will happen is the Fed will lower the rates. And then what will happen with the slow as when the inflation starts coming in and it slowly starts raising the prices, that's when the Fed, they're going to have to come in and they're going to have to cut the rates. But when the inflation not raising as high as they want, that's when they'll come in and they'll raise the rates. So it's always a balancing act of how long should they keep the money cheap? How long should they keep the money expensive? What is everything else in the market is looking like? And that is usually when money becomes expensive. That's when liquidity dries up. That's when assets become less attractive. And that is when bull markets crack. And that's when a crash happens and everybody thinking the sky is falling. Okay. And when liquidity leaves the market, that's when money starts tightening up. You start seeing banks say, oh yeah, our regulations to get to, like, they start raising it was a 600 to get a house now they'll raise it to a 620 because they want to see why they want to cover their ass, because now the requirements to get these loans are tighter because because money is becoming more expensive, which means they're going to tighten their loan requirements. Over leveraged companies and all of that, that's the ones that's going to go first. All of the risky investments in the meme stocks, they the ones that's going to crash first. And then the market's going to correct. And after they crash, that is right now what we're in. We're in the market down phase, but it's not really a bear market, but we cooled off. We're in this phase where we could go either way right now. Like I said on a couple videos ago, we like in a consolidation phase right now. So right now, the Fed is not rushing to cut the rates. So because their interest rates is still high, and also this geopolitical tension, and I'll get into that. So the big lesson most investors is going to focus on: stock tips, headlines, social media hype, internet gurus, and all that. But the real question smart investors ask is liquidity expanding or is it tightening? And once you can see is money cheap or expensive, you can kind of gauge what phase of the market you're in, because it's all determined by what money is doing. Is it cheap or is it expensive? Okay, so when liquidity dries up, bull markets, bubbles, crashes, understand that concept already puts you ahead of most investors, because most investors don't understand bull markets. They don't understand they don't understand bubbles. They don't understand crashes. They just understand green, red, buy, sell. They don't understand the phases and what they should be doing. Should they be buying more? Should they be buying less? Like, they don't even understand that. So just because you understand this piece of information that I'm giving you right here, you're going to be light years ahead of most investors. So I'm gonna close out with this because I ain't gonna keep y'all here long, man. The market cycle is not random. We already went over that. Like, it's not random. It's part of it. Like, it's heavily influenced by the cost of money. It's not no earnings. It's not headlines. It's all about cost of money, how cheap or expensive money is to borrow. And everything else is just noise layered on top. You already know what it is, man. So appreciate y'all for being here, man. Make sure y'all tap in. You already know what time it is, man. And let's go out here and get this money.